Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be discussing the nuances and headwinds of ESG investing. Donald Trump is back in the White House, and with his return comes a seismic shift in policy, trade, and markets. One movement caught in the crossfire is ESG investing. But let's be real, ESG's struggles didn't start with Trump 2.0. The backlash has been brewing for a while now. Some see ESG as a critical part of investing, while others call it a glorified marketing gimmick. So, in this episode, we're diving deep into ESG investing in the new political landscape and what it means for individual investors. Now, before we get into that though, let's take a quick look at what's been happening in the markets this week. First up, Perplexity AI is making a power move with a $50 million venture fund looking to back early-stage AI startups. With 80,000 developers using its API, Perplexity has a front-row seat to AI's next big winners. This isn't just about competing with Google anymore, it's about shaping the future of AI itself. This move follows its $500 million fundraising push and an ambitious bid to merge with TikTok US, signaling just how serious Perplexity is about dominating AI. Meanwhile, the UK and India are dusting off trade negotiations, aiming for a long-awaited deal that could boost investment in key sectors like clean energy and financial services. Negotiations stalled last year due to elections, but sticking points remain. India wants better visa access and social security benefits, while the UK is eyeing easier market entry. With India poised to become the world's third largest economy by 2028, British businesses see a major growth opportunity. However, past Brexit-era promises of a quick deal have proven elusive. A UK-India trade deal seems like a no-brainer, but the fine print could drag talks on yet again. Over at Apple, the Vision Pro is facing a tough reality check. A year post-launch, a lack of must-have apps is slowing down adoption. Developer interest is fading, and big players like Google, Meta, and Netflix have yet to release key apps. The high price and slow adoption have kept the app ecosystem from taking off, unlike the iPhone's early boom. Indie developers are still experimenting, but sales remain small. Meanwhile, Meta's Quest platform has surged, offering cheaper hardware and a larger app marketplace. So, without more compelling apps or a cheaper, lighter model, the Vision Pro risks becoming a niche product rather than Apple's next big thing. Then there's BP, taking a sharp turn back to oil and gas, walking back earlier promises to cut production and slashing its low-carbon investment plans. Investors like the move for profitability, but long-term competitiveness could take a hit. This shift reflects both investor pressure and the reality of persistent fossil fuel demand. Higher upstream spending and cost-cutting efforts could boost profitability, but scaling back renewables may hurt BP's long-term position. Elliott Investment Management's growing influence suggests more shakeups could be ahead. BP's reset is a bet that oil demand and investor patience will outlast the energy transition hype. On the tech front, Nvidia continues to dominate, posting a 78% jump in AI-driven revenue. The company issued bullish guidance, signaling confidence that it can continue to dominate, even as growth slows from last year's breakneck pace. Investors are eyeing Blackwell, Nvidia's next-gen AI chip, which CEO Jensen Huang calls its fastest product ramp ever. The data center business now makes up 91% of total sales, overshadowing gaming and networking. Share buybacks hit $33 billion, rewarding investors handsomely. While Nvidia remains the AI king, its future growth hinges on maintaining its hardware advantage against custom chips from big tech. And lastly, in the world of entertainment, Netflix is making a bold play, building an anti-Disneyland. Instead of traditional theme parks, it's going for mall-based entertainment hubs, VR partnerships, and pop-up experiences. Their strategy aims to create repeat visitors rather than one-time high-cost tourists, leveraging flexible attractions and digital integrations. In our eyes, this move signals a long-term play to monetize IP beyond streaming, but its financial impact remains uncertain. Unlike Disney's $34 billion theme park empire, Netflix's venture is lower risk, but it's unproven. If executed well, Netflix's anti-Disneyland could drive brand engagement and diversify revenue, but it's a gamble on whether fans will come back for more. Now, let's get back to ESG investing and how its role is evolving in today's market. ESG investing saw massive inflows between 2019 and 2021, but momentum has cooled. Despite this, total assets in ESG funds have still grown to over $3 trillion. But there's a kicker. 84% of those assets are in Europe, with the US lagging far behind at just 11%. At its core, ESG is about measuring a company's impact beyond profits. Environmental factors include pollution, emissions, and resource use. Social factors look at workplace conditions, ethics, and DEI initiatives. Governance covers transparency, risk management, and shareholder rights. The idea is to create a framework that evaluates companies not just on financials, but on their broader impact. However, ESG remains controversial. For some, it's a tool for risk management. For others, it's a murky, subjective concept that can be easily manipulated. For example, Tesla was dropped from the S&P 500 ESG index while ExxonMobil remained, and that raised eyebrows. Apparently, Tesla was dropped due to labor and safety issues while Exxon was included because it scored better than other oil and gas companies. Go figure. The cost of ESG compliance is another issue. Companies with deep pockets like Microsoft and Alphabet can afford to maintain high ESG scores, while smaller firms struggle. More profitable companies can afford to invest in renewables and pay high wages, while smaller firms struggle to meet ESG requirements due to compliance costs. Now, let's move on to what ESG investing could look like under Trump 2.0. It's well known that Donald Trump has never been a fan of ESG principles, and with his return, we're already seeing rollbacks in renewable energy incentives, DEI policies, and climate disclosure rules. The SEC's climate-related disclosures, which were already on hold, are set to be rolled back completely. Trump's administration is also expected to ease regulations on fossil fuel industries, making it harder for ESG-focused companies to compete in the US market. Corporate leaders in America have already started to abandon previous commitments to net zero alliances and DEI initiatives, signaling a shift in priorities. With these rollbacks, the flow of capital into ESG funds, particularly in the US, is almost certain to slow down. However, despite the backlash, ESG isn't disappearing entirely. The European Union is enforcing mandatory ESG reporting starting in 2028, which means international companies will still need to comply. Even in the US, states like California are pushing their own sustainability regulations. And with major asset managers still viewing ESG as a useful risk management framework, companies may continue to integrate ESG principles, just with less emphasis on politically charged elements like DEI. For individual investors, the takeaway and insight here is clear. ESG has value as a risk management tool. Institutional investors and fund managers need to pay a lot of attention to ESG because they are trying to keep various stakeholders happy. For individual investors, things are simpler. You might decide to invest in certain industries while avoiding others. That decision will dictate the universe of companies you consider. Assessing and deciding which companies to invest in should be a separate decision. The risks posed by ESG factors are the ones that don't show up in a company's financials, so it's important to do some research to see what those risks might be. There's a lot of uncertainty surrounding certain industries at the moment, particularly renewable energy. One way to reduce risk is by identifying companies with multiple tailwinds or catalysts. For example, a narrative on the platform covers a stock called MCOR, which provides mechanical and electrical construction services offering exposure to electrification and renewable energy. However, that isn't its only tailwind. It also benefits from data center expansion, reshoring, and infrastructure spending. In other words, MCOR isn't entirely reliable on renewable energy. As always, you can find great narratives like this one and plenty others from investors in the Simply Wall Street community on the platform. And that's all for this week's episode. If you'd like to read the full piece, please check out the link in the show notes. You can subscribe to our Market Insights email list on your Simply Wall Street account under the Notifications tab. We'll be back next week with more insights on market trends. Until then, invest well.